And here's chapter 4, consolidation of wholly owned subsidiaries acquired at more than book value. So what we're going to talk about today is we're going to talk about the situation where companies are buying 100% of the stock of a subsidiary, but they're paying more than book value. There are two basic reasons why they could be paying more than book value. One reason is because of goodwill, and the other reason is because the assets are worth more than book value. So the first thing we're going to do is we're going to talk about equity method journal entries related to the differential. And what we mean by the differential is we mean the difference between the amount of money that the parent is paying to buy the subsidiary and the book value of the net assets of the subsidiary. So in other words, the subsidiary is going along and its assets have a certain value that's on their books. And then the chance that a parent is going to pay the exact book value for the sub is almost zero. The parent is going to pay whatever the sub is worth, and it's probably not book value. That difference is what we call the differential. So on the parent's books, what will happen is the parent will record the investment at its cost, whatever it paid. And that would be the fair market value of the net assets plus goodwill. If there's a bargain purchase gain, then the investment is actually going to be recorded at the fair market value of the net assets. And that's kind of a weird situation that could come up. It's pretty rare, but most of the time, it's just going to be recorded at whatever the parent paid. And again, if there's a bargain purchase, that's going to increase the amount per se. If there's a bargain purchase, then you're going to record it at the investment account, the acquisition cost, plus whatever the gain was on the bargain purchase. So that's kind of an unusual situation of the bargain purchase. We've talked about it before, and we'll keep talking about it soon. And the parent can account for this investment on its own books using whatever method it wants. It can use the cost method. It could use the equity method. It could do the method that we're using, that we're going to talk about here in this chapter, but it could also use a different method. The reason why the method doesn't matter is because the parent is going to need to consolidate the sub. And when the parent consolidates the sub, then whatever method it used is going to be undone. So this is really just paperwork. It's not actually going to affect the accounting financial statements that the parent is going to release, because the parent is going to need to consolidate. And that'll undo whether they use the cost method, the equity method, whether they use the equity method properly with write-ups and write-downs or not. It doesn't really matter because it'll all be undone in the consolidation. On the subs books, the assets and liabilities are going to remain at book value. Now, there are times, by the way, we'll talk about this, there are times when the sub will actually write up its assets to fair market value on the date of acquisition. Likewise, the expenses will be based on the original book value that the sub had. And the sub is not necessarily, if the sub had to write up its assets, then it would be depreciating more. But it's not writing up its assets, and therefore the expenses would be somewhat understated as a result. So what happens when you consolidate the parent subsidiaries' books and subsidiaries' books? All of this is undone, because the parent has already recorded the investment at fair value, and even though the subs books contain only their historic book values for whatever the sub originally paid for all these assets, this will all be undone when you do the consolidation, as I'm going to show you in this chapter video. So the parent is going to need to adjust for the balance sheet and the income statement of the sub to account for the goodwill, and also account for write-ups and write-downs of the assets. Now, we dealt previously with created subs, and why didn't we have this problem when we were consolidating subs that the parent created? Because there were no write-ups and write-downs in that situation. There was no goodwill to worry about. Everything went on the subs books at its original cost, and that really was the parent's original cost. And as we're going through this, you might want to remember my little chart here, where we recorded the book value. We have the cost. We have three values of the subsidiary that are floating around. We have the amount of money the parent paid for the subsidiary. We have the fair value of the net assets, and that is whatever the company, we look at all the assets and all the liabilities, and whatever they're worth, that's what they're worth. And then we have the book value, that is the value of the assets on the books of the subsidiary. Now, the difference between the cost of acquisition and the fair value of the net assets is what we call goodwill. And the difference between book value and the fair value of net assets are the write-ups and write-downs of individual assets and liabilities. And a lot of numbers get switched around when we're going about doing this. What we're going to do is we're going to take the subs books, which are there at book value, and we're going to write them up, usually write them up, but it may mean write them down. We're going to adjust those books to the fair market value of the assets and liabilities on the date of acquisition. So what this means is that if you're going to write up your equipment, then you're going to have more depreciation expense. If you're going to write up your inventory, then when the inventory gets sold, you're going to have more cost of goods sold. If you're going to write up your patent, I'm just talking about write-ups, but some of these could be write-downs too. If you're going to write up your patent, then you're going to have to amortize, because you can't put any assets on the books without it eventually hitting the income statement. So your patent could be written up, but then you're going to have to amortize it. And the same thing with goodwill. You might say, well, goodwill, you don't have to amortize goodwill, right? We learned that. Well, the fact is that sooner or later, goodwill is going to be impaired. And if it's going to be impaired, then that is going to hit the income statement. So in most cases, these things are going to be written up. And therefore, in other words, equipment, inventory, patent, goodwill, well, you don't have negative goodwill at all. But you're going to be creating assets. And since you're creating assets, as these get written off, it's going to increase your expenses. So what's going to happen to the income statement is these are all going to reduce consolidated income. And the parent is going to need to record additional expenses as you depreciate the additional write-up of the equipment. You write up the equipment. Now you need to depreciate that write-up. You write up your inventory. Now the inventory gets sold and you have higher cost of goods sold. And I'll show you how this works in a few minutes. So when an investor purchases the common stock of another company, the purchase price normally is based on the market value of the shares acquired rather than the book value of the investee's assets and liabilities. In fact, the book value of the investee's liabilities is completely irrelevant, because that is historical cost minus depreciation. And it probably has very little to do with the real value of those assets. Now, some assets might be pretty close. Like if those assets are valued at fair value, if you're talking about, marketable securities, then you can pretty much, or cash, right? You can pretty much assume that whatever the book value is, that's the fair value. But there are other cases, there are other assets that are recorded cost, and they might even be depreciated, where the book value on the books of the sub has nothing to do with the real value, or very little to do with the real value of the assets. And so these are going to need to be written up to fair value on the date of acquisition. And when you write up assets, you can't just put things on the income statement, on the balance sheet. You can't just record assets and forget about them. If you're going to write up equipment, that means you're going to have more depreciation. If you're going to write up an intangible asset like a patent or a trademark, then you're going to need to record more amortization. So this is a differential, and this differential is going to need to be accounted for, and eventually it's going to hit the income statement. So let's go through an example. Alright, so here's an example. Ajax bought 40% of common stock of Barclay for $200,000, and Barclay's net assets were $400,000. Barclay's net fair market value of net identifiable assets is $465,000. The land was undervalued by $15,000, and the equipment was undervalued by $50,000. Now, this example, which is in the book, of course, is not quite it's not an example of 100% acquisition. This is rather an equity method acquisition, because as you can see here, it's only 40%. But this will show you how the write-ups and the write-downs play an important role, and how you would account for a differential in an equity method investment. So in this case, we're only going to deal with 40% of the investment because it's an equity method investment and it's not a 100% investment, as we're going to see later on in the chapter. Cost of the investment was $200,000. The total book value on the date of acquisition was $400,000, and Ajax's share is 40%. So therefore, Ajax's share of the book value would be $160,000, and that would give us just a differential of $40,000. Now, there's several write-ups, write-downs that needs to be done here, and you need to be very careful and cognizant with write-ups, write-downs, and how these things are worded, because the wording can get extremely confusing. It says here the land was undervalued by $15,000. That would mean that 100% of the land needs to be written up by $15,000. And we didn't buy 100% of the company, so we're not going to write up 100%, but that's besides the point. What's the key thing to realize here is that it's going to be a write-up of $15,000. And it's the same thing for the equipment. It says the equipment is undervalued by $50,000. So that means the equipment needs to be written up by $15,000. And 40% of that would be $6,000. That's our share. And 40% of the $50,000 write-up of the equipment would be $20,000. So the total write-ups that apply to our equity method acquisition here are $26,000. So of this $40,000 differential, $26,000 relates to write-ups, $6,000 is land, and $20,000 is equipment. Now, also, the cost of the investment again was $200,000. Let's try and figure out Goodwill, and we're going to do this in a manual way, and then we're going to do it in a more. We're going to use my little shortcut to do it after this. So the fair market value of the net identifiable assets is $465,000, and again, Ajax's share, because Ajax is not buying the whole company, is 40%. So therefore, the fair market value of the net identifiable assets of Ajax's share is $186,000, and therefore the difference between the cost of the investment, $200,000, and the fair market value of the net assets of the investment is $186,000, and the difference between those is $14,000, and that's the goodwill. Now this chart here again summarizes this very nicely. We're investing $200,000. Our share of the fair market value of the net identifiable assets is $186,000, and our share of the book value is $160,000. So the goodwill would be 200 minus 186, or 14,000, like it says up here. And the write-ups and write-downs would be 186 minus 160, or 26,000. We know that 6,000 of that is land, and 20,000 of it is going to be equipment. So how does Barclay record this? Barclay will debit investment in Barclay stock for the total value of the investment that Barclay happens to be making, in this case $200,000, and crediting however they're paying for it, in this case cash, for $200,000. And then we have equity method income. Total income of the sub, of Barclay rather, was $80,000. So under the equity method, the journal entry would be to debit investment in Barclay stock for Barclay's share of this income. That'd be $80,000 times 40%, or $32,000. And credit income from investee, or income from investment in Barclay. I'm going to just write investee here. I think the book says investment in Barclay. And that would be $32,000. And then there's the dividend. So for the dividend, the journal entry would be debit cash for the amount of money received. That would be $20,000 times the 40% investment. Credit investment in Barclay stock, $8,000. And now this is where things get very tricky. This equipment here needs to be depreciated. You can't just record $20,000 write-up of equipment and forget about it. It's equipment and it needs to be depreciated. Now the land is land, so it doesn't need to be depreciated. And goodwill doesn't need to be depreciated either, but goodwill needs to be tested for impairment. And if it's impaired, then the parent's share of it needs to be written down. So how much is the depreciation? It says that the equipment has a 5-year life. So the depreciation would be the amount of the write-up, which in this case is, let's see, $20,000 divided by 5 years, or $4,000. Now, you might say depreciation expense, right? But no, because this is being recorded as income from investee, it's not being consolidated, then you're going to debit income from investee for the amount of the depreciation. And again, that would be the amount of the write-up divided by the useful life of the equipment, 5 years, or $4,000. And the credit would be to investment in Barclay stock. In essence, what you're doing here is you're reversing. This is how we recorded income from Barclay. So therefore, if we have additional expenses, then this is how we're going to record those additional expenses of $4,000. Now let's take this a step further, and let's suppose that in 2022, Barclay reports income of $150,000, but that included a gain, a $50,000 gain on the sale of the land. And the land is a little complicated because we determined that we wrote up the land by $15,000, and now the land is sold. So how are we going to account for that? First thing to do is equity method income. Let's assume there's no dividend here. The equity method income is $150,000, right? So our share of it, debit investment in Barclay stock for $150,000 times 40%, or $60,000, and credit income from Barclay stock, or from investee, that's what I've been using, of $60,000. Now, the total gain was $15,000, but we only own 40% of the stock. So therefore, that's going to be 40% of that gain, or $6,000. So what happened was we wrote up the land. So therefore, the gain would be reduced by the amount of the write-up, because the land to us is actually more valuable, and therefore the amount of the gain, and to us the land had a higher book value, therefore the gain would be $15,000 lower to us. But we only own 40% of it, so therefore it's going to be $6,000. It's interesting. We write up 40% of the investee. The other 60% belongs to other companies. They don't really care. They didn't pay us what we paid for the 40% investment. So this will be just a reversal. This catches up a lot of students. This will just be a reversal of the income entry. For $6,000. It should be noted, here you can see that's my ebook. It should be noted here, you also need to record another $4,000 in depreciation expense on the equipment. That should be noted there. So that would be the same entry as we recorded up here. That's going to need to be recorded for 5 years. So it's not shown in the book. I'm not even sure that the book mentions it. That's what I was just looking at. But you can't forget that. And again, it's the same journal entry. It's not debit depreciation expense, credit accumulated depreciation, but rather you're going to reverse the income entry, because when we record income from this investee, this is the entry. So if we have additional expenses that the investee did not record, then that's just going to reverse this entry rather than being recorded as depreciation. If you recorded depreciation expense, that would imply it's depreciation of the parent's assets, which we certainly do not want to do.